Welcome to the Deep Dive, the place where we take complex research and, well, we boil it down to the essential knowledge you need to be seriously well informed.
Exactly.
Today, we're diving into a stack of sources that don't look at climate change and, melting ice caps, but rather its direct, measurable impact on your portfolio.
That's right. We're talking about the severe financial consequences of climate vulnerability.
So our mission for this deep dive is to analyze this huge global data set. It runs from 1995 to 2017, and really pull apart the relationship between a country's climate risk and a really nasty financial outcome.
Firm-level stock price crash risk. It's not just a bad day on the market.
No, we're talking about those sudden, painful, market-destabilizing events. And the study we're looking at uses the country-level climate vulnerability index from the Notre Dame Global Adaptation Initiative, the ND-GAME index.
Which is really the gold standard for this kind of thing.
It is. And the main finding is it's actually incredibly stark and simple.
It is. If a country is highly vulnerable to climate change, the firms operating there face a significantly higher risk of a massive, abrupt stock price crash. It's a direct line. The vulnerability of the place translates to instability in the stock.
Okay, let's unpack this, because we really need to define our terms clearly here. Let's start with climate vulnerability.
That place to start.
If you hear that term, you might just think, a country near the equator, maybe a coastal region. But that's only half the story, right?
It's way less than half the story. If we connect this to the bigger picture, you're exactly right. Vulnerability isn't just about geography. According to the IPCC, the Intergovernmental Panel on Climate Change, vulnerability is sort of a two-part equation.
Okay.
The first part is that geographic risk, your predisposition to be adversely affected, how exposed you are to rising seas or extreme weather.
That's the location piece, the part you can't really change.
Exactly. But the second part, and this is the one we really need to pay attention to, is the capacity of that country to adapt.
Oh.
And that depends heavily on socioeconomic conditions. Things like stable governance, infrastructure, education. You can have high climate risk, but if you have high adaptive capacity, you are much less vulnerable overall.
That distinction feels like the key to this entire deep dive.
Yeah.
And the ND-GAIN index the study uses, it breaks that two-part equation down into three measurable parts.
It does.
First, there's exposure, and that's, like you said, largely fixed. It's the biophysical exposure to climate change. It doesn't matter how rich your country is, your coastline is still there.
Right. Then you have two components that are time variant. They can change. The second is sensitivity.
And what does that mean?
Sensitivity measures how much a country relies on sectors or, populations that are really vulnerable to climate hazards. Think of an economy built almost entirely around rain-fed agriculture, for example.
Or massive populations living in low-lying areas.
Precisely.
And the third component, which you hinted is the most actionable one, is adaptive capacity.
This is the big one. It's the availability of social resources, the strength of your institutions, the quality of your healthcare, the state of your infrastructure, everything a country can mobilize to mitigate harm or even seize new opportunities.
So here's the crucial part, the finding about these three metrics.
Yes. The study found that adaptive capacity has the strongest, most persistent explanatory power for crash risk.
In layman's terms.
It means a country's ability to cope, to adapt, to govern itself effectively. That is the number one protective factor against the financial instability that climate risk causes.
That makes perfect sense. Resilience equals stability. Okay, now let's define the other side of the equation, the financial problem. When we say stock price crash risk, what exactly are we talking about? This isn't just a bad quarter.
No, not at all. It's a very specific event, and it's rooted in corporate management behavior. The theory, which was developed by Jin and Myers back in 2006, basically says that managers have a general tendency to hoard bad news.
So they hold on to negative information.
Yes, things like poor earnings, legal trouble, or the very real costly risks from local climate vulnerability. They do it to protect their careers, their bonuses, maybe the firm's stock price in the short term.
They absorb the bad news. I'm picturing it like filling a balloon.
That's a perfect analogy. They keep that balloon of negative information inflated until they either just can't hide it anymore or they reach a kind of tipping point.
And that pops.
It pops. And when that balloon bursts, all that accumulated, withheld negative information floods the market all at once. And that triggers a dramatic, non-linear stock price crash.
So the core finding of this research is that country-level climate vulnerability basically just fuels this bad news hoarding behavior.
It pours fuel on the fire.
So let's nail down the proof. Does this macro level risk a whole country's vulnerability statistically and significantly increase a single firm's risk of one of these crashes.
It absolutely does. The data is very clear. Climate vulnerability significantly increases the likelihood of a fund facing subsequent large, sudden negative returns. This isn't just a bit more volatility. It's something different.
It's a specific increase in the probability of those extreme negative outcomes.
How big is the effect? I mean, investors need to know the scale of this. What does, say, a 1-unit increase in climate vulnerability actually translate to in risk?
The magnitude is substantial. It's enough to completely reshape a risk model. A 1 standard deviation increase in a country's climate vulnerability leads to about a 32% increase in the frequency of those large, sharp stock downturns.
Wow. 32%.
And it also predicts about a 29% increase in a measure of volatility, where the downturns are way more extreme than the upswings. It's a massive destabilizing effect, all driven by macro risk, filtering down to micro market behavior.
30% is huge. To make that tangible for you listening, let's look at the geographic contrast. The ND Jane Index gives us hard numbers. Who's managing this risk well, and who is really exposed?
Well, when we look at the economies that have minimized their risk, it's always the ones with high adaptive capacity. Strong institutions, good infrastructure. For example, Norway scored extremely low on vulnerability, around 0.264.
Okay. Switzerland was at 0.272, and Finland was 0.298. These are countries built for resilience.
Which explains why their firms are more stable, regardless of any local environmental risks they might face.
Precisely. Now, on the other hand, the countries identified in this data as most severely affected, the ones with the highest vulnerability scores, include Pakistan at 0.540, India at 0.511, and the Philippines at 0.484.
That difference it's just stark. And for a global institutional investor, that's not just a political risk footnote.
No, it's a quantitative financial risk that affects every single firm in that region.
Right, so that sets up the critical question. How do we know this connection is causal? I mean, vulnerability isn't random. Countries that are poor or unstable are often vulnerable for a bunch of different correlated reasons.
That's the endogeneity problem.
Exactly. So how did the researchers prove that enhancing adaptive capacity is the specific mechanism that reduces crash risk?
To isolate that causality, they looked for specific, sudden, non-random changes, what they call policy shocks, that clearly boosted a country's adaptive capacity, and then they measured the financial impact right after.
Okay, so tell us about the first major shock.
The first one they looked at was the enactment of worldwide climate laws. These are formal, legally binding national strategies, things like new climate targets or mandatory emission regulations.
Things that fundamentally improve a country's institutional framework for adaptation.
Yes. And the analysis showed that after one of these laws was implemented, firms in that country experienced a significant sharp decrease in crash risk.
And the timing is key here, I assume.
Crucially, the decrease only happened after the law was enacted, not before. This confirms that the formal institutional change, the boost in adaptive capacity from a concrete policy, is what stabilized the market. It reduces the manager's incentive to hide bad news.
And they even found this effect at a more local level, right, in the U.S.?
They did. For their second shock, they looked at the adoption of U.S. state-level climate change adaptation plans, or CLAPs.
CLAPs.
Okay. These are state-level plans designed to proactively map out risks, reduce negative impacts, and even find growth opportunities related to climate change within that state.
And what happened?
Firms headquartered in states that adopted a CLAP saw a demonstrable decrease in their crash risk compared to control firms in states that hadn't adopted one yet.
So what does this all mean? The fact that a global climate law and a local U.S. state plan,
Both formal institutional changes.
both resulted in lower stock crash risk. That really confirms that strengthening adaptive capacity is the most effective protective factor. It's the resilience component that gives the market confidence.
It completely shifts the financial risk discussion.
Mhm.
The market is telling us that it doesn't just worry about the next storm. It worries about a government's ability to handle that storm institutionally.
Let's get into the mechanics then. We've established that managers hoard bad news, and that causes the crash. But why does macro climate vulnerability make them hoard more intensely? The study found 3 channels linking the country-level risk to that micro-corporate behavior.
Right. The first channel is pretty foundational. Weak firm fundamentals. When a country is highly vulnerable, it's just associated with weaker future performance for its firms.
So they face higher default risk, lower business quality.
Exactly. Climate risks just naturally generate more genuinely bad news that managers would be tempted to hide. The core business health deteriorates, and that generates the anxiety and the secrecy.
Okay, that makes sense. What's the second mechanism?
The second is the aggressive bad news hoarding itself, the act of secrecy. The researchers found that increased climate vulnerability directly leads managers to obscure poor operating performance.
And they had a specific example of this, right? Goodwill impairment.
A great example. Goodwill impairment is when a firm has to admit that an asset or brand they bought is actually worth less than they paid for it.
It's an accounting loss.
A big one.
Yeah.
And managers often delay recognizing it, even though they know it's coming, to avoid the immediate hit. But this delaying behavior it's a ticking time bomb.
Kicking the can down the road.
Exactly. Until the loss is too big to ignore, and when it finally hits the books, it's a massive shock that can trigger the crash.
And the third channel. This one involves institutional ownership.
Right. The third mechanism is a narrower institutional ownership breadth. What that means is that climate vulnerability reduces how many active mutual funds or dedicated institutional investors own the stock.
So the big professional investors get spooked and sell.
They do. When they anticipate these adverse, volatile effects, they're discouraged from investing. And when these active monitors pull out, the market loses its ability to incorporate bad news accurately and on time. The price stays artificially high because that critical scrutiny is gone, which just sets the stage for an even more dramatic crash.
That brings us to the good news then. The buffers. We know vulnerability increases crash risk, but what factors act as, sort of, insurance policies that make that effect less pronounced?
Mitigation comes in a couple of forms, economic and institutional buffers. Let's start with the economic one, foreign trade.
How does selling things internationally help a company deal with a local climate risk?
It's all about diversification. High involvement in foreign trade, whether that's a country's trade balance or a specific firm's foreign sales acts as a really important buffer.
Because if local supply chains get disrupted,
Having international assets, revenue, or customer bases mitigates that destabilizing effect. You aren't putting all your eggs in one climate basket.
okay, that makes sense. And on the institutional side, what about the role of stronger governance at both the country and the firm level?
At the country level, robust governance is a vital constraint on bad behavior. We're talking about strong anti-theft rules that protect minority shareholders or really effective corporate boards.
So the laws themselves force more transparency.
They do. They make it harder for managers to hoard bad news in the first place. And at the firm level, foreign institutional involvement helps too. The presence of, say, a Big N auditor.
One of the big reputable accounting firms.
Or higher foreign institutional ownership. That means you have active, demanding external monitors. They essentially let you import good governance, and that weakens the main effect by demanding better disclosure.
Beyond formal rules and foreign influence, the study also looked at the surprising impact of local cultural and social norms. How can those act as shelters against this kind of instability?
They found they also act as a constraint on manager behavior. First, look at stakeholder relationships and environmental norms. The crash risk effect is weaker in countries that are more stakeholder-oriented.
Where society expects companies to serve more than just shareholders.
Exactly. These active stakeholder groups are always demanding better environmental performance, and that forces managers to be more honest about climate risks.
And what about core cultural traits? The study drew on some established indices for this, right?
This is where it gets really interesting. They found two specific cultural dimensions that act as powerful buffers. The first is high uncertainty avoidance.
Okay, what does that mean?
These are cultures that feel more threatened by ambiguity and uncertainty, and their response is to implement strict rules and policies to mitigate that uncertainty.
So because climate change is so inherently uncertain, their cultural impulse is to proactively build those strong adaptive institutions we talked about earlier.
That's it exactly. Their proactive rule setting reduces the need for bad news hoarding because they've already put safety nets in place. The second mitigating culture is indulgent cultures.
That one seems counterintuitive. How does being indulgent help financial stability?
Well, indulgent in this context means cultures characterized by flexibility and a high value placed on creativity and innovation. This cultural environment actually encourages firms to undertake innovative environmental investments that support adaptation.
Like developing new resilient technologies or processes.
Right, and by supporting that kind of adaptation and innovation, The market instability from climate vulnerability is significantly reduced. It just makes bad news hoarding less necessary.
That is a remarkable finding, that financial stability is linked not just to GDP and laws, but to the cultural DNA of a country.
If you connect it all together, the overall findings are, well, they're undeniably clear. Climate vulnerability is a significant destabilizing force in global financial markets, and it's primarily because it increases the incentives and opportunities for information manipulation by corporate managers.
And enhancing that adaptive capacity through formal institutions, through strong cultural norms, that's the most effective and persistent countermeasure.
Without a doubt.
This research has massive, actionable relevance for you if you're an international investor or anyone managing a global supply chain. It really underscores that when you're selecting investments or assessing operational risks, you have to move beyond simple risk matrices.
You do. A country's institutional and cultural preparedness, its adaptive capacity, is a core financial risk factor. It predicts the stability of the entire market.
So, as we wrap up, let's leave our listeners with one final thought.
This research focused heavily on the deliberate information manipulation by corporate insiders, by the managers. And we should acknowledge that the lack of mandatory, standardized climate-related disclosure in most countries, well, it facilitates this very problem.
It creates the environment for it.
It does. And considering the profoundly uncertain nature of climate change, this raises a really important question for future exploration. As these risks become more and more salient, how might this information uncertainty lead to more aggressive manipulation by other market participants, like speculative traders, an issue that could undermine global financial market stability even further?
Something to mull over next time you look at a volatility index.